Hello and welcome to my report on the financial health of Xero. First, we will look at I'll provide an overview of the company and also dig into its governance and sustainability. We'll then perform a 5-year historical analysis on its financials and then provide a 5-year forecast on its financial as well. We'll also dig into the reimagined workplace and how Xero fits into this new concept. And I can assure you the findings at the end of this report will be very reassuring for investors. Now, without further ado, let's start the overview. Xero is an accounting SaaS platform. It was founded in New Zealand in 2006 and is primarily focused on small and medium-sized businesses. It claims to be so easy to use and also has over 1,000 apps that can be used in its digital ecosystem. It can be used anywhere where you have internet, the home, office, or even the local coffee shop. It has an operating revenue of $718 million, free cash flow of $27 million, and a gross margin percentage of 85%. Now let's review or dig into detail Xero's governance and sustainability. Governance is built on values, practices, which aligns with all stakeholders. It is good corporate governance will assist in sustainable and a profitable company. How has Xero enacted good corporate governance? Well, first they've appointed EY as their independent auditor, which is a big tick. In their 2020 financial reports, they've outlined risk management and also highlighted the importance of data security. However, there is an opportunity for Xero to seek accreditation for data security. They also outline the importance of gender diversity, inclusion in leadership. In 2020, the board consisted of 3 males and 3 female members. However, I must note that all members appear to be white Anglo-Saxon. Considering 30% of Australians are born overseas, I believe there is an opportunity for Xero to make sure their diversity includes cultural diversity. Xero has a very strong sustainability program. For example, in 2019, they introduced the Net Zero program where they purchased carbon offsets. By 2020, they'll carbon neutral, and they aim to continue carbon neutrality moving forward. There's also an opportunity for Xero to embrace how SaaS can improve the environment. Cloud computing can save billions of tons of CO2 emissions by 2024, according to some newspaper reports. Just imagine if you're working from home in this reimagined workplace, how many times you need to drive in the office, or more importantly, how many times you don't need to drive in the office. We are now going to perform a 5-year historical financial analysis on Xero, focusing on liquidity, its solvency, profitability, how management of efficiencies of its assets, and return on equity. The first place to start when looking at a company is its liquidity, to make sure that it can meet its short-term debts. So in definition, liquidity is the ability for a company to meet short-term debt using current assets. Now, the last 5 years, you can see in the current ratio graph, in 2016, it was about 4.5%, then dipping in 2018 to 1.9, and then skyrocketing to 5.5 and 6.1 in 2020. It's always been above 1%. Commentators indicate that anywhere between 1.5 to 3% is a good indication of its liquidity. There was acquisitions in 2017 and 2018, which allowed for the current ratio percentages to creep up to 5.5 and 6.1 in 2019 and 2020 respectively. This has placed Xero in a strong position leading into the COVID pandemic. The next item to look at is Xero's solvency. And solvency is the ability for the company to survive over the long term. And the formula used is total liabilities divided into total assets, and then we times that by 100 to get it into a percentage formula. Now, over the last 5 years, the graph here will show from 2016, it was at 14.9%, and then in 2020 it reached up to 63.4%. So over the last 5 years, total assets have exceeded total liabilities, and a good indication of the solvency ratio is anywhere between 40 to 60%. So you can see in 2019 and 2020, it's a touch above the 60%. So this will be an interesting percentage to watch when we do our 5-year forecast. However, as you can see also, it has plateaued in 2019 and 2020. So the solvency once again has placed Xero in a strong position going into COVID. We're now going to analyse the profitability of Xero, and we'll be using the EBIT, so the earnings before interest and taxes. And you can see on the graph or the bar chart on the left hand side of your screen, the EBIT in percentages has definitely increased. You can see in 2016 it was negative 24.7, or in 2020 it's jumped to a positive at 4.1%. So what is pushing, or what is driving this increase in the EBIT? Well, there's two things that can do that. That is either increasing the gross profit margin or decreasing the cost of sales. Now, if we have a look at the Xero's revenue and cost of sales graph on the right-hand side, that blue line is going up, and that's the revenue. So revenue is growing, which is great to see for Xero. And you can also see in that orange line, cost of sales has maintained or is flat and has decreased a little. Actually, what's happened is gross profit margin has increased from 75% to 85% over 5 years. So that's really good news for Xero, and this has placed Xero once again in a very strong position leading into COVID and also for the reimagined workplace. So the next item we'll investigate or explore is the total asset turnover, which will measures the efficiency of a company's assets in generating revenue or sales. This is really important. As you can see here, it's gone up, which means that it's generating, this asset in Xero is generating more income, which is great. But then what happened in around 2017, it went down and it's slowly going back up. So what happened in this period here? Well, Xero acquired some new software. Now it'll take time for this new software to start contributing towards the revenue. So I guess in summary, time will tell if this asset that they bought will actually improve their total asset turnover. And this is one item we'll investigate further in our projection of revenue. The final historical analysis we'll perform on Xero is the return on equity using the DuPont analysis. Now, without going into too much detail about the more sophisticated mathematical equation that builds the DuPont analysis, I'll provide a very simple explanation, and that is where net profit, total asset turnover, financial leverage or equity into a financial equation to provide a more informed view on return on equity. Now, if we turn our attention to this line graph, we can see already that the line graph is going up, which just general common sense means something good is happening. So we can see there's definitely an upward swing, and we can see from 2017, it went from negative 30, jumped up to, within about 3 years, jumped up just above 0 and just a touch below 1%. Now that's an upward swing. That's indicating that we are starting to see a better return on equity. However, we should be aiming for about 10% return on equity, which is a general industry standard to go by. So my take on this is we have to allow time to see if this return on equity will build out, will improve. So this is one part that we'll definitely look at when we do our 5-year forecast. So to provide a quick summary of the 5-year financial analysis of Xero, most indicators that we analysed is on the upward upward trend. However, I think there's still room for improvement, definitely room for improvement, if we look at two specific analysis: the return on equity using the DuPont analysis and the total asset turnover. And we'll look at more detail of this in our 5-year forecast. Now, before we jump into the 5-year forecast for Xero, I think it's really important to explain some of the assumptions that are driving the 5-year forecast. The first one is the sales will increase on average 25%, 15% and 10% year on year. Now, this is based on the fact that over the last 5 years, from 2016 to 2020, sales as percentage has gone down in Xero to where in 2020 it was at 29%. After in 2016, I think from memory, it was around 40-odd%. So as you can see, it's definitely gone down, and that's why I've decreased the sales figures as a percentage. Now, the gross profit margin will maintain at 85% year on year. Now, that is at the 2020 levels. We'll also continue with the assumption of software acquisitions, which is the business strategy of Xero. We'll also assume that Xero will continue to focus on small and medium-sized businesses. And finally, the cost of goods and expenses will continue in proportion to the 2020 figures. So first, let's look at an overview of the 5-year forecast using those assumptions and drivers which I mentioned earlier, and put that into an income statement. And you can see the trend is up. Everything is going up, which is great to see. But let's dig a little bit deeper to see what is growing and where some areas that we can definitely improve in a 5-year forecast. The next 5-year forecast we'll turn to is the DuPont return on equity forecast. Now, if you recall back in the historical DuPont return on equity, it was below 1. It was in the negatives, but it was actually on the improve. And you can see down here in this line graph, it was in 2020, it was 0.8. Now, what's happened using those assumptions that I've outlined earlier is the return on equity has definitely improved, which is great to see if you're an investor. So you can see here, it's all coming on the improve. And one indicator is anything around 10% is a really good indicator. And you can see here from about 2020 onwards, it is above 10%, which is great for Xero. However, interestingly, it sort of plateaus out from 2020 through to 2025. Now, that will go back to the drivers I put into the forecasting model, where sales plateaus out around 10%. Now, another 5-year forecasting tool that I've used for Xero is the debt to asset ratio. And I've actually included the data from 2016 and forecasting from 2020 or 2021 onwards. Now, you can see from this line graph, it's pretty obvious that total assets have definitely been on the improve since about 2020. And the total liabilities has only marginally inclined. So you can see this huge gap from about 2020 to 2023, there's a huge gap, as you can see here, between the debt to asset ratio. Now, what does that mean? That means that creditors are forecast to own less of a company or less of Xero, and assets will grow. And this means that shareholders will own more of their company, so their equity will increase. Now, we'll discuss a little bit later, what does that mean? Another analyst tool for the 5-year forecast is the asset turnover ratio. Now, you can see from 2021 to 2025, it hasn't improved greatly. It should be at around 2 or 2.5. So my takeaway from this, work still needs to be done to get more bang from their assets. The final 5-year forecast is the shareholder equity, and you can see by these bar graphs, equity is definitely improved. So at some point, the shareholders would, I'd imagine, be expecting to see some sort of dividends from Xero. Now let's examine how Xero will benefit or fare in a reimagined workplace. However, first I should note that these predictions have not been placed in Xero's 5-year forecast because I still believe there are too many unknowns how the world will evolve post-COVID. Now, the first prediction is that Xero may see an increase in the value of their intangible assets on their balance sheet. Their business strategy is driven by acquiring SaaS companies that support their customer base. SaaS businesses are ideally suited for the reimagined workplace, so as you can work from home, from the office, or the coffee shop. And I believe the market will increase the value of SaaS companies, in particular the acquisitions by Xero. The second prediction is I predict that we'll see an operating expenses increasing and then returning to a degree of normality. Why? Well, the reimagined workplace has driven the need for IT skills that is driving wages. Xero is an IT-driven SaaS platform. However, with the Australian borders opening up and COVID retreating in areas such as India that provide a large degree of IT skills remotely, I can see wages decreasing and returning to a degree of normality. And this will affect Xero's income statement. So in summary, Xero's SaaS business model plus the reimagined workplace provides for a bright future for Xero and its shareholders. In particular, it has a very strong balance sheet, has very healthy gross profit margins, has its costs under control, and there are opportunities to improve its sales figures. On a governance side, it should look at increasing the cultural diversity of its board members, and on sustainability, Xero should embrace how SaaS is a great green business model for its users. So in essence, Xero is a great company, it's got a great future, and its investors should be looking at some form of return in the near future.